Welcome YouTube, my name is Matt. Here on this channel, I'm going to talk about all things personal finance, investing, and business. The topic for today is real estate and how it is a huge driver in building your net wealth, particularly if you're getting started in life. There are three common objections I usually hear when discussing real estate with folks, and they center around the down payment, PMI, and what happens if I have to move. So I'm going to address each of these as we walk through this example. Let's consider a typical example of someone who's renting currently. And let's say their rent is $2,500 a month. Maybe they have a roommate, maybe they're living on their own. Either way, it won't matter for this example. But let's say they're considering buying a home. And let's say a home that meets their needs, that has the right numbers of bedrooms and baths and located near work or other activities they're interested in, is about $300,000. So going over to the Zillow mortgage calculator, we can do some quick calculations on this example. So going over there, let's tackle the first objection, the down payment. So depending on your career path, you may be able to get a mortgage with as little as 0% down. But let's assume for a minute you're not VA or other special categories and can't take advantage of that program. They're available to everyone is something called a FHA mortgage, which allows you to have as little as 3.5% down. So on a $300,000 property, this is going to be $10,500. A lot, especially if you're getting started, but not an insurmountable amount if you were thinking you needed 20% down to get started. As part of that mortgage payment, there's going to be a couple of components. There's going to be interest, insurance, property taxes, and because we're below 20% equity in this example, private mortgage insurance, which will each add to the down payment. So doing this example and using the current market average interest rates available today of around 5.4%, the mortgage payment in total for this example is around $2,179. So already a good start, quite a bit below the rent example that we gave in previously. Now there's a couple of things you need to think about that make up that payment that I was just mentioning. And some of those are to your advantage in many ways. The first being interest. So you pay interest every month to the bank for the loan, and you'll have a total interest at the end of the year after you make your first 12 payments. And in this example, this will total up to $15,575. I did an insurance annual example of $900, and I assumed the property taxes for this property would be about 1% per year, so added another $3,000 for that. So in total, that's $19,475 into the property just on all those expenses. Now that sounds like a lot, and it is, but the great thing about this is depending on your individual situation, this could be tax deductible. Let's say you're currently single filer on your taxes and you get a $12,000 automatically as part of your standard deduction. So if you were to itemize, which you could potentially under these circumstances for the end of the year, you'd have quite a bit above that $12,000. You'd be at the $19,475. So you take the difference between those two, and that's how much more you could potentially save every year at your end of your taxes. So $7,475. Let's say you're in the 15% tax bracket. That right there will net you about $1,121.25 in a refund at the end of the year. Great. But there's more. Throughout each of your mortgage payments, you're paying down the principal, which for a 30-year mortgage at these rates is approximately 25% of the payment. So it ranges between $322 and $338 per month. Over the course of those 12 months, you'll have paid $3,961 toward principal, which is great. That's like a forced savings account that will add to your equity position and improve your net worth. You also, on average, in good real estate, can expect about 3%. Some years will be negative, some years will be quite a bit higher than that, but on average in good neighborhoods, you can expect to see that. So in this example, that's $9,000 a year. So just from principal pay down and appreciation you can expect, That's $12,161. That's more than your entire down payment for the first year. So you're already coming out ahead that quickly. And that doesn't even account for that tax refund we talked about as well earlier. So that quickly you're coming out ahead. But you may be saying, hey, as part of that mortgage payment, I'm paying private mortgage insurance until I get to a 20% equity in the house, which can be a couple $100s per month, which is a lot. But the great thing is, already you're still way ahead paying this difference, and that will eventually go away in the future as your equity in the house continues to go up, both from principal pay down and appreciation. So in as little as a few years, that could be wiped off the calculation, and right away you could be getting another $200, $300 off your mortgage payment. Great. Now the last objection we haven't talked about is, what if I need to move? Great question. It can be frustrating to try and sell a house, find a realtor, make all that happen smoothly while trying to move to your new place. But one option I'd like you to strongly consider is going in with the plan that you're going to rent the place when you leave. This gives you a couple advantages that I'll talk to in another video, but that should be a part of your buying calculation. Look at the comps in the area, understand what a reasonable rental rate is for a high-grade tenant. So essentially look at the averages, pick the lowest, and as long as that is around or above what your mortgage payment is, you'll know you'll have a great option with a property manager to make your life much easier to rent the place, quickly move, and then have your tenant start paying this mortgage for you. And there's a lot of other interesting tax advantages to consider once you go down this road, but that gives you a lot of flexibility so you can continue to do this process over and over again as your net worth continues to grow. And before you know it, you could have a portfolio of several properties, tenants in there either paying off the house or in the process of doing that. And then at the end of 30 years, you'll have this paid off house. It will have appreciated potentially 2 or 3-fold over that time. And you'll have the option to either keep renting it for income, sell it, move it into another type of investment or diversify, or otherwise do with it as you wish. But just wanted to go over these common objections, whether it be the down payment, making sure everyone knows how small of a down payment you can manage under the current loan programs available, why PMI isn't really that big a deal because it goes away in a few short years, and your ability to rent the place after to make sure it's a performing asset for you long term, and allowing the next series of tenants to help pay down that mortgage. And you also get the personal satisfaction of providing a nice quality place to live, because if you're buying a place that you're willing to live in, you know it's nice, so you're providing another great place for someone else too. That covers the real estate topic for today. I'll probably deep dive into this further in upcoming videos, but thanks for tuning in. Please like and subscribe, and I'll talk to you again soon. Thanks, bye.